everybody's settled in, we're going to get started here. I'm Jessica Franchuk. I'm editor of Metal Roofing Magazine and Frame Building News. On behalf of Rollforming Magazine, the Construction Rollforming Show, and Shield Wall Media, I'd like to welcome you all to the 2019 Construction Rollforming Show. We are offering educational programs and launching the Construction Rollforming Association as part of an effort to help encourage best practices and grow a safe and profitable industry. I'd like to introduce Jeff Sellner and Allen Wright. They'll be presenting on financial planning for succession or selling. Guys, take it away.
Thank you.
Thanks, appreciate that. So my name is Jeff Sellner, and I'll just do a brief intro and then I'll let Allen do the same. We're both with CliftonLarsonAllen, which is a national service firm. By background, I've been at CLA for a little over 20 years. I'm a CPA. And as an opportunity, being a CPA, working with privately owned businesses and business owners over the last 20 plus years on accounting, tax, and other things, you know, obviously, as you probably know with your own privately owned business, there's a lot of other things beyond accounting and tax things that come up from time to time that you need advice on, and that's one of the roles that we play, and we can help business owners. And through my experience, spent a lot of time working with business owners on helping transition family-owned businesses to either the next generation or a combination of how do we make sure the business is set up for the most opportune outcome, whatever that might be, whether that's selling to the management team or transitioning, gifting to the kids, getting the company ready for a sale to either a strategic buyer or a private equity group, whatever that might be. So that's where I spend a lot of time now. Myself and a handful of others are working on building out a team of people across our firm that is focused on helping business owners plan for their exit. And you'll hear terminology: succession, selling, exit planning, owner transitions. I would say those are all the same terms for the same thing. Those are terms that all mean the same thing, which is you might own your business today, and at some point you will not own your business, whether it's by choice or by force. Like it or not, we're all not going to live forever, so at some point in time you will no longer be an owner of your business if you're a business owner. The question is, how do you plan for that, and what's the right time period? I'll let Allen introduce himself a little bit here as well.
Sure. Good morning. My name is Allen Wright, as Jeff said. I too am with CLA, CliftonLarsonAllen. I've been there 4 years, but I've been a wealth advisor, financial advisor for the past 20 years. Got the gray hair to prove it. Been through cycles in the economy and helping clients think about and plan for, you know, their personal financial situation, and plan for what's next is a big part of what I do at CLA. So I work, as Jeff said, we have a lot of business owner clients who are at various stages along their journey. And our job is to just kind of come alongside them and help them figure out, okay, let's kind of take a picture of where you are today and then map out where you want to be in 10, 15, 20 years down the road. So with that, we provide retirement planning, investment management, pretty much any of the kinds of services that you might expect or you might think about when you think about financial advising. That's what we do as part of our practice at CLA. We've been at that for a very long time and are continuing to build our practice. Our firm, we are in about 120 offices across the country. So we've got clients in all kinds of communities, all kinds of industries. We've seen businesses large and small. Our firm only works with closely held business owners. As Jeff mentioned, we provide tax and audit work, but even that work that we do is with closely held business owners. We don't work with any publicly traded companies, and that's by choice, because we believe that we can add more value by consulting and helping the small business owner or the privately held business much more so than working with a large public company. So that's kind of the philosophy that we have as a firm, and we really enjoy it, and we like the consulting side of what we do.
And I presume everyone in this room works for a privately owned business. They don't work for a public company, right? So to our point, and you know why this topic and the types of businesses that Allen and I and our colleagues work with, we're pretty passionate about for a lot of different reasons. And personally, you know, I grew up on a family farm, and you think about small business and family farms and and other businesses like yours. I mean, these are the backbone of our economy, and you think of the need to help these companies build strong companies. I mean, small businesses is really what employs and where you're seeing a lot of the job growth, right? And the economic activity and the trades and manufacturing. And so, you know, for us, that's exciting. And we have the opportunity to work with companies in a lot of different ways. And we like working with stakeholders, you know, people who are not just emotionally invested in their business, but also have financial investment in their businesses too. So it's a different dynamic working with people who have skin in the game. So this topic of financial planning for succession or selling or exit planning, whatever term you want to use, you know, the reason why this is important is I think a lot of times people think about financial planning in one context and they think about exit planning in another context. And what we're trying to do is marry these two up and say, you really can't do one without the other. If you're thinking of financial planning and one of the assets on your personal balance sheet is a privately owned business, there's a lot of nuances to that Alan will talk a little bit about here in a minute about how that interplays with your financial plan and what kind of financial planning you should be doing to make sure that you realize that asset in terms of its value. On the flip side, when I'm working with business owners on exit planning, you know, a lot of times they're thinking about it in the context of the end game, which is their ideas on how they want to transition their ownership. But you really have to pull them back to the financial plan as well. And so we're going to talk and interplay here between Alan and myself around why it's important that you can't do one without the other. You can, you should not. You should be doing these in the context of each other. So just overview, Alan's going to talk a little bit about comprehensive financial planning. What is that? Everyone has a little bit different mindset about what's the definition of comprehensive financial planning. I'm going to talk a little bit about exit planning. What is exit planning? What are some just takeaways? You're not going to be an expert by the end of the day, but hopefully between the two of us we can have some dialogue and give you some pointers that you can take with you to think about. And then how do these intersect? And being with the size of the room that we have, and there'll be people coming and going, I'm sure, and we're competing against, I guess, inventory management. And what's the other topic over there? So maybe we'll get some people coming in at some point in time and fill the room. But this should be an interactive. I mean, if you have questions, by all means, raise your hand. And, you know, don't be shy. We like questions. We want to make sure it's relevant to you and your business and what your situation is. So by all means, feel free to interject. Sound good? Okay.
Great. All right, so as we get started, show of hands, who all in the room is an actual either partial or full owner of the business? Wow, okay, just everybody, okay. Who in the room has thought about when you may, or beginning to think about what the next phase might look like for you? Who's been thinking about that or has that kind of on their mind right now? Okay, good to know. Jeff mentioned a moment ago some of the terms that we're going to use some are going to be interchangeable, but there are a few distinctions that we also wanted to talk about. Exit planning, a lot of times I will hear estate planning used in the same context as exit planning. Estate planning is when you're talking about what's going to happen when you're no longer here, when you pass away, what's going to happen to your assets, right? What's going to happen to the business and so forth. That is a part of exit planning, but exit planning is a much broader topic. It's a much broader area. So exit planning and estate planning are not exactly the same. Exit planning is a little bit broader. We often talk with folks about retirement and the sale of the business. One of the things we want to kind of get across today is that a sale of your company, a partial or full sale of your business, doesn't necessarily equate to retirement, right? I know Jeff and I both worked with a number of clients who have sold some portion of their business, but are not retired. Either they're still active in that particular business or they moved on to yet another business. So retirement and selling your business don't mean one and the same. And I bring that up because sometimes we'll work with business owners who this notion of selling their business suggests that they are retiring. And so they can't get beyond that, no, I'm not ready to retire, so why would I even think about selling my business? Well, the two don't have to, I mean, one can exist without.
That's a great point. I mean, in my career, I've also had the opportunity to work with a lot of different industries, and one of the industries is technology companies. Yeah. And if you think about technology companies, which changed my whole mindset about exit planning to manufacturing and construction and other companies, is these young entrepreneurs were thinking about exit planning in their 20s, right? How do I sell my business? I started a company, I grew it, I'm 28 years old, maybe I want to sell, you know, I mean, and do it again. And it just kind of, it changed the whole mindset of this concept of retirement is not selling my business or exiting.
Right.
They're disconnected, but, you know, I think in most privately owned businesses, they tend to be interconnected or linked, certainly, but we should think about them as two separate events.
Ownership versus management. Again, ownership and management don't necessarily, I mean, I know everyone knows this, but ownership and management don't necessarily mean one and the same. Just as we talked about, selling the business may not mean retirement. On the flip side of it, you can still obviously be an owner of your company, but not want to be involved in the day-to-day operation. And so the two, structuring how you want to maintain some or a total level of ownership, but not maybe be involved in the day-to-day management or be involved, that's a part of the exit planning conversation as well. So those two are not necessarily, don't have to be one and the same. How many people sometimes feel like this when you're thinking about the future? DVR. Now, I'm going to have a few of these corny slides, so you've got to give me some feedback. The idea of planning for the future is programming the DVR. I've literally worked with clients who have kind of felt that way about thinking about the future. I'm so caught up in the day-to-day management of this business, I really haven't had the time to think about what's 10 years from now or 20 years from now. I'm just trying to keep this thing afloat, or we're trying to grow this thing. So I can't get there yet. So we want to kind of not have this approach, and we want to be thinking about opportunities down the road. So why are we even talking about financial planning? Jeff did a great job of kind of setting the stage, but there are some data points too that are really causing this whole idea of exit planning and financial planning to really be at the forefront of a lot of conversations that advisors like us, tax folks, lawyers, and others are having with their business owner clients. One big data point is the Bohr Effect. So pretty much if you were born between 1946 and 1964, you're kind of technically referred to as a baby boomer, part of the baby boomer population. Pretty much age 55 to the early 70s, that's kind of the baby boomers. The baby boomers represent, according to this study, it's about 2 years old, 9 million of America's 15 million business owners were born in this baby boomer group. That's a huge number. That same group controls 70% of the spending in America, consumer spending. Huge numbers. So you got this 2 decades of population growth that has had this huge and is continuing to have this huge impact on our economy. For many business owners, not just the baby boomers, so that 15 million business owners, many of those business owners, 85 to 90% of their personal net worth is tied up in their business. We all may feel that, right? Because we're living it every day. So that several studies have talked about how, and Jeff mentioned, the interconnection between your personal financial situation and your business situation.
I think one comment on that, and you know, you might hear this, Alan, as well from clients that you're working with. You know, owning a privately owned business is a great way to create jobs, create economic activity, and personal wealth. You know, you're working so hard in your business, I've talked to business owners that have said, gee, I've never felt like I've had the opportunity to build so much wealth until I owned a privately owned business. Obviously, there's risks that come with that, but I've never felt so cash poor, right? And so you think about all it takes to operate and run your business. You're even, as you make money, you're putting it right back into the business in most cases, right? You're building that 80 to 95% balance sheet asset on your personal net worth, and then the real question is, well, how do you spend a privately owned business? Well, you got to convert it to cash at some point. You have to create liquidity, so that 85 to 90% is a big number.
Yeah, it's a big number. I asked everyone to raise their hands a moment ago about who had thought about exit or transition planning in the next 5 years. About 40 to 50% of the people in the room raised their hands. And that's kind of what the surveys continue to show of this baby boomer group, and really business owners in general. You just have a lot of folks who are between that age 50, in the mid-50s to the early 70s, who are now starting to get at that point where they are thinking about what's next. And what has triggered some of this, the Great Recession. You have a lot, we have conversations with business owners who in some cases feel like they've missed their window of opportunity. Or they felt like the recession was so hard on their business that they were barely able to keep it afloat. And they don't want to take that ride again. So when the next recession comes, so they don't want to kind of be in that situation. So that has also triggered a lot of business owners to start thinking, well, maybe while things are going well, we've recovered, we made it through that. Don't really want, that was fun, but I don't want to go through that again. So maybe let's start talking about what's next. So all these things are kind of triggered by you have so many business owners now thinking about that. Just a couple more quick data points. From that same study that where the 40% were thinking about transition, a large percentage of those business owners did not have a transition plan, or if they had one, it was all up here. It wasn't anything that was written down. It wasn't anything that had been communicated to family members or other folks in the business. So that transition plan is all kind of up there in the mind. And we're going to talk about why we need to get that out of there. There are a number of different reasons, but many, just said, man, I don't really have a transition plan yet.
How many of those that raised your hand that's a business owner, which is most in the group, have a detailed transition plan in mind? Or have an idea of what you're going to do with the ownership of your business?
I have an idea.
You have an idea?
I've communicated it.
You've communicated it?
Certainly not planned.
Okay. Yep. And that's, so, that's pretty much consistent with what we see across the country. And that's what we're trying to do, is educate people on why is it important to Alan's point earlier, you're busy running day to day and you don't want to be thinking about the what ifs, and that's not part of the short-term plan. We'll talk a little bit about, later I'll talk a little bit about what are some reasons, even if you're not thinking of an exit plan in the next 5 years, why should you do planning today? But that's a good point. So one has done some thinking about it, and I'm sure everyone has thought a little bit about it, but not beyond the communication of a plan. Yeah.
CLA, in 2018, our firm commissioned a study amongst our clients, manufacturing and distribution clients in particular. And we went through a series of questions. Well, one of them related to preparation. How prepared do you feel for a transition? And just wanted to give you kind of a breakdown of what our clients showed. 19% of the manufacturing and logistics businesses or distribution businesses that we serve, very well prepared for what's next, that transition. 54% somewhat prepared, 23% somewhat unprepared, 4% felt very unprepared. So it was an interesting result on the study that we did a few years ago.
I think the interesting thing would be, how did they define very prepared? Did very prepared mean I have a plan in my head and I told one person about it? Or was very prepared mean I have an actual documented plan that everybody knows about? If I get hit by a bus, what's going to happen, or the other people involved. So it's kind of interesting. I think those statistics still are a little bit frightening in the sense that people are fairly unprepared, or not quite as clear as they could be.
Speaking of frightening, a little dark financial planning humor for you. Kind of get everybody. I've literally spoken with folks where I've asked about the exit plan and the transition plan, and the response that I got was, well, I'm just going to keep working, and my plan is hopefully I will die while I still have some money left over and that can be passed to my kids. And it's like, okay, that's really not a plan. That's let's kind of build some things around that. But there are folks who kind of, as Jeff mentioned a moment ago, don't feel that they have the financial resources there to last them in their lives. And there are a couple of reasons why people are feeling a little bit more anxiety about this. As we all know, life expectancy is growing in this country. So now when we sit down with an individual who's thinking, okay, I'm 65, I'm thinking about retirement, or maybe a little bit earlier or a little bit later than 65, you may be planning for a 25 or 30-year retirement in theory. So life expectancy is growing in this country. So what that does, from a planning standpoint, it just puts that much more emphasis on the assets that I have today, the income that I have today or going to have in retirement. it's gonna have to last me for a longer period of time. So I need to really be planning, because before, 30, 40, 50 years ago, by the time we retired, life expectancy was maybe 15 years after retirement, 80, 82, early 80s. Now, 95, 96, 97. My grandmother died at 103 on my wife's side. I don't know that I want to live to be 103, but my wife's got a lot of longevity in her side of the family. So that has financial implications for us from a financial planning standpoint.
I think the other thing that's interesting too, and this is one of the stereotypes, I guess, whether it's factually true or not, I think it's generally direct in terms of baby boomers. You know, strong work ethic, hardworking individuals that don't see retirement as I'm going to work necessarily to a particular age. And that, you know, we see a lot of baby boomers that say, I'm going to work until I can't work. Well, tell me when that is. I don't know. Well, that puts a little more pressure on the financial planning and exit planning when you want to work until you can't physically come into the office anymore, but you have to start making plans obviously well in advance. So there's some of those dynamics generationally different than millennials and Gen X's and so on that I think play a part in how this all comes together.
Yeah. So comprehensive financial planning or financial planning really, you know, if you think about it, it really helps to answer two key questions. How much do I need? You see commercials sometimes say where these investment firms say, what's your number? You know, what's your number? What's that number? I don't think of financial planning as much about a number. Yeah, we need to know what my cost of living is going to look like, what that's going to cost in tomorrow's dollars. I think about it being more directional in nature, because quite frankly, if you focus on a specific number, that number can become obsolete as soon as you walk out this door, because things are constantly changing. So when I think of financial planning, it's more directional. Are we headed in the right direction? Are we still growing assets? Or have we kind of taken the risk out of our portfolio, so now assets aren't growing as much, but they're giving us income? But how much do I need is a key question that planning can help you answer. Is there a wealth gap? And a wealth gap basically means, okay, I sat down with Jeff, or I sat down with Alan, or my advisor, or I calculated out myself on my spreadsheet that from this age forward, our lifestyle is going to cost us about this much. We like to travel. My family, we like to travel. I like to fish. I like to shop. I like cars. Whatever it may be, that lifestyle has a cost associated with it. So when you think about retiring and when you think about, you know, financial planning, you want to kind of ask yourself, okay, of the assets that I have and the sources of income that I have coming in, Social Security, pension, income from the sale of my business, or cash from the sale of my business, when I add up all of that, how does that compare to it out to cost me? And is there a gap? And the planning process helps to figure out, A, if there is a gap, and then B, how we can close that gap. What are some of the strategies to start putting in place to begin to narrow that, close that gap? Related to the question of how much I need is how much is enough? How much is enough? And that's a deeper kind of question that a lot of business owners or a lot of clients struggle with. How much is enough? I mean, we've had this kind of lifestyle for all these years. We've been working in the business and so forth. I think when I'm kind of done with the day-to-day management of the business, our lifestyle will stay the same. Well, maybe it will, maybe it won't. If you get a big chunk of cash from the sale of a company, your lifestyle may change just like that. You may now want to start doing more things than perhaps you weren't able to do when you were running the business. So that's one of several of these factors. Which one is that?
The one on the right on the side.
The red dot?
Oh, the red dot is should be the middle.
Okay.
There you go.
So some of the factors to think about when you're trying to answer these questions, how much do I need and how much is enough? What is my current spending and my time horizon, right? And when you think time horizon, the time horizon can mean a couple of different things. It can mean how much longer I'm going to be working and accumulating versus the time that I'm going to be in distribution mode, where I'm no longer building assets. Now I'm taking assets away. I'm starting to draw on that 401k. I've accessed my pension. I'm starting to take cash out of my savings to live on because I don't have income coming in anymore. So that's an example of what that time horizon will be. What is my current spending now? Again, if you sold a portion or all of your company, you get this big chunk of money, liquidity, how does that change your spending level, your lifestyle? Company-related expenses, this is a big one. I'm working with a gentleman right now where he's got a great company, he's looking to sell. Many of his day-to-day expenses have been covered by his company, healthcare, insurance, his car, taxes. A lot of that he's been able to flow through his company. But what happens when you don't have that company anymore? And those are now on your dime. You're paying out of pocket for those things. That's one of the big considerations that you want to take into account when you are thinking about transitioning out of your business, selling your business. Major expenses that might come up after you've sold, again, how do you fund those things? And then the impact of both income and capital gains taxes. Taxes have become, and will continue to become a big part of the equation for us. It used to be estate taxes was the big issue, but now income taxes actually have become as important for individuals as anything. Definitely anything.
No, I completely agree. I mean, I think, and I'll touch on this a little bit too, but I can certainly talk about it now. But the tax piece, when you're transitioning your business, whether you're transitioning to family, you're certainly, or selling to maybe your employees, maybe you have a leadership team that wants to buy your business from you. You know, you think of all the different ways that owners exit their business, and I'll touch on a list of those later, just different options. But, you know, thinking about how does the tax piece come into play, and unfortunately it's overly complicated. And that's not because of Alan and myself, that's because of just the tax rules in general. And so I think just making sure you understand what are the pros and cons of different ways that you exit your business, I think are absolutely critical, because you could, whatever your plan might be, needs to pair up with the financial piece, which includes the tax planning and so on, because you don't want to be surprised at the end of the day that you accomplish your goal of transitioning your ownership, whether inside or outside of your teams, and then find out you have a large negative tax consequence that would have caused you to make a different decision had you known. And so I usually tell people, whether it's tax planning or even financial planning, exit planning, whatever you do, just be intentional about it. The only way you can be intentional about it is to look ahead. Yeah. Are there any questions at this point? Any thoughts? No, again, feel free to ask questions as we go. Things come up.
So planning helps to answer a couple of questions. It helps to crystallize what your goals may be. And so those goals can vary. You know, reduce anxiety about money. A lot of us have anxiety about money. We just do. You might be making a lot of money, you might not be making a lot of money, but studies have shown that we walk around and carry a lot of anxiety about financial matters with us throughout our lives. Planning can help reduce some of that stress and take some of that stress away. Generating income and cash flow. Again, I have a client I'm working with right now. He's been retired for 3 years. He's got, you know, a significant amount of assets, but he is still very stressed about where his income, his retirement income, where he's going to be pulling that from. So we've had to really kind of walk through a nice planning process to get him comfortable that, hey, he's not going to be broke. He's going to have enough income to last him and his wife throughout the rest of his life. Transferring wealth to heirs. A lot of business owners think about, okay, it used to be where there was a large percentage of folks I talked with who said, I want to transfer money to the kids. When we're done, my wife and I have decided, or my spouse, we've decided we want to leave a bunch of money to the kids. That has changed a little bit, because I think a couple of different things. If you've helped your kids with a down payment on a home, or if you've helped to pay for kids to go to college, these are significant investments anymore. That's a lot of money. That requires a lot of financial resources. And many folks today say, you know, we got to kind of think about our own retirement. And so the transferring wealth to heirs maybe isn't as much of a priority for us as it used to be. But there are still a number of folks who want to think about whatever's left over. If there's a lot of assets left, or little assets left, whatever's left over, we want to transfer that to our heirs in the most tax efficient way that we can. We don't want to be in business with Uncle Sam if we don't have to. We don't want to give 40%, 45% to Uncle Sam. How can we get more of this to our heirs? So go ahead.
And I was going to say too, you talked about transfer to heirs, and even, well, you'll touch on this with Shareholder. Not to steal your thunder on that component, but I even see now more than ever people saying, well, just for your points about paying for kids' college education or whatever it might be, going, you know what, I worked hard for this wealth. I'm not sure I want the next generation to get all of it.
Yep.
Right? And believe it or not, I hear that statement probably more than I ever thought I would.
Yeah.
And so, again, I'll let you touch on charitable, but I think there's other ways than just thinking about, well, you know, I don't want my son or daughter or others to have my wealth now, they can have it when I die. Well, now we're finding people saying, I don't even want them to get it all when I die.
Yeah,
I want an alternative.
Yeah, that is true. Charitable giving, some folks are charitably inclined, others not so much. And with me, with the clients I work with, it's about 50-50. I work with some clients who say, yes, we want to, you know, we want to give to our local church, we want to give to our local university, where we alma mater, you know, community initiatives. And others say, you know, no, I just kind of want to keep these assets that we've accumulated, I want to keep it in the family. Yeah, we'll disperse it within our family, but we're not necessarily charitably inclined. But for those who are charitably inclined and we're giving money away either now while alive or later after we've passed on, is a high priority. There are strategies through the planning process that can help do that in a way that's tax efficient. You can get tax benefits now by making charitable contributions through certain types of vehicles. It can be a very powerful way to reduce your tax liability, estate taxes, and so forth, which is what this one says. You can't see it, but that basically says strategies to minimize estate taxes. That's pretty much all that one is there. And charitable giving can be a way to help do that if you're inclined to do that or even not. And then finally, if the goal is to sell and transfer a business, which is what we are talking about here. Just quickly, the goals-based planning process, financial planning used to be, okay, Alan, I've got X amount of dollars in cash. We're going to put so much in stocks, so much in bonds, keep so much in cash. Project out how much that's going to be, and that'll be my number, and that's kind of how we'll work. And we're going to assume that the stocks are going to earn 10%, the bonds are going to earn 5%, the cash is going to earn 2%. That's the way straight line financial planning used to work. Now, financial planning is so much more advanced because it's not about what the stock market is doing. That should not be the driver of your estate planning process. What should be the driver, or your financial planning process? What should be the driver is what your goals are. The clients that we work with who say, I really don't care what I see on television when I go home about the stock market was up 10% or it was down 5%. I just want to know that whatever we're doing with my assets, the goals, the growth that we need to have in my portfolio is matching up to my personal goals. This is my personal journey. I'm less concerned about what my neighbor says. Oh, my portfolio was up 25% last year. Yours wasn't? Well, you know, that's not a horse race that you want to get into. Goals-based planning basically is about you identifying what's important to you, not financially, from a lifestyle perspective. What are those things you want to get out of life? And then it's ultimately you got to assign some costs to that lifestyle. But that's the identifying and prioritizing the goals. That's the beginning of the goals-based planning process. And then you just kind of go through a strategy. Analyze, evaluate what your assets are, like I mentioned earlier. What do I have? What's my nest egg look like? Sources of income. Now let's come up with a plan to monetize, liquidate, access those assets as we need to. Here, activate and implement your plan. And then finally,
I think I turned the brightness up too much.
There you go. That's right. But that's just monitor and adjust your success. But it's a circular process. Financial planning is not a one-time thing that you do and then don't do it again for 15 years. Financial planning is an ongoing process because life is constantly throwing you curveballs. There are adjustments that are needing to happen in your life. So the planning process should be adjusted as well. So it's not a one-time, here's your financial plan, go forth and do well, soldier. That's not how financial planning works. It should be an ongoing process where you're revisiting your goals as things are changing and making sure that your goals are staying in line with your plan.
The one comment I want to make on that, I've worked with a lot of Alan's colleagues on the financial planning side, and one of the things that's eye-opening, and I can even relate to this myself and my wife, as well as a lot of times, and most for those that are married, you find out that one of the two spouses is probably more financially in tune with what's going on with whether it's financial resources, investments, retirement planning. And usually one of the other spouses, or the other spouse, is not as either interested in it. I can tell my wife will tell me, you know, I don't want to know any of the details, and I'm like, no, you have to. And that's what this financial planning process also involves, is getting, if you're married, couples together as well, and really open a dialogue around these kind of things, because what you find is, you know, giving a venue for people to share their goals and objectives financially, you know, you're all busy, I'm busy, my wife's busy, and how often do we sit down together and look at each other and say, you know, what's your financial goal? You know, it's probably not as often as we should in terms of our next 10, 20, 30 years of our lives. And so it kind of forces that conversation, and it's really kind of liberating, I think, for most people that they have that opportunity to share in that kind of forum that you guys provide.
Yeah, this is, without question, this is the heavy lifting of any planning process. It's the hardest part of the planning process, to get folks to just slow down and start thinking about goals. And to Jeff's point about spouses, I've had so many interactions with clients where I would maybe speak to the one person who's more kind of the driver of the financial conversation, and we'll talk and say, yeah, well, and I'll suggest, well, why don't you bring your spouse in, and we'll sit down and talk together about these goals. We're pretty much in sync on what the goals are. Yeah, I bet you are, but why don't you bring that person in anyway? Never fails, every time. When we get them right there across that table, at some point there's a disconnect, and they look at each other, and there have been a couple of times where I'm going to say, okay, well, you all finish that conversation on the way home, but clearly we are not in sync, or the level of priority that one had on a particular goal versus somebody else, or versus their spouse, is very different. So it is important to not only do this, but to then get in sync with, if you have a significant other who's contributing or a partner on the wealth picture, to get that part done right and get it done together. When you think about financial planning, this is just kind of some words that kind of capture what was in that last picture. What's most important to you? What are you trying to accomplish? Put priorities and dollar amounts to these goals. The dollar amounts is where people like myself and Jeff will come in and say, okay, well, you said this is the kind of lifestyle you want to live. Let's start. What does that really mean? You say you want to travel every year. Does that mean you want to travel from one state to the next and spend $500, $600 on a long weekend? Or does that mean you want to travel overseas and spend $10,000 for a trip? So what does that really mean? How do we put dollar amounts to those goals? I talked about taking an inventory of what you have now and later, because those are going to be the engines going to fuel that retirement in that plan, and then just develop a plan with specific strategies to achieve the goals.
You find out a lot about people through this process, right? I mean, how many times have you probably sat through and learned about, or spouses learned about other spending habits or desires of the other spouse? And an example, I remember sitting in a client meeting, and the husband and wife were talking, and it turns out, you know, you find out that, you know, the husband has a large gun collection he loves, or a coin collection, or something, you know, and the other spouse goes, hey, one, you should put that on the balance sheet, and two is, how much more money do we need for that, for that hobby?
Yep.
You know, and it just kind of lays everything out in a way that sometimes people, not necessarily lack of transparency, but it's a way to bring a full financial picture together in a way that people probably have never seen before.
I've always wanted a boat. It's going to cost about $40,000. Oh, really? Okay, I never knew you wanted a boat. You add that to the list. I mean, you'd be amazed at the kinds of things that come up in these conversations once you get people talking. This idea of goals, and there's a priority with goals. We kind of think of them as needs, wants, and wishes. The needs that we have, those are the things that we cannot do without. Those are food, shelter, clothing. You know, we have to have those basic necessities covered. So those are the kind of the foundational essentials that we have when we're kind of building out the financial plan. Okay, what's the bare minimum stuff? And what's the cost of the lifestyle that we need to have for these basics? Then you kind of, as you start to move up the level of the pyramid here a little bit, what are the things that we can do to ensure the lifestyle that we want to have? When you have a conversation with clients sometimes, and they say, you know, this is the kind of lifestyle we have today, but if neither of us were working, we think our lifestyle would either be the same as what it is, or it might be significantly more active than what it is today. Well, that being more active may have additional costs just to kind of maintain the same kind of lifestyle that you want. Again, if you have a scenario where a lot of your expenses are being covered by the company and now they're on your own dime, that's also what this insuring lifestyle helps to get at. If you just want to stay level with where you are today, but now your company's not paying for these things you're paying, what does that look like and how important of that is that to you? And then obviously having resources for the unexpected, and then leaving the legacy. So that's kind of the priority list. That's one version of it. Needs, wants, and wishes is kind of another way that people tend to think about these priorities for the personal goals as part of building their financial plan. You can't see this well, but this is just a snapshot from the software that we use. There's all kinds of financial planning software out there. And what you see here, up here at the top, the conversations that we have here are, so really, some people are visual learners, so we'll sit down and we'll just kind of talk through these goals. So we break it down, needs, wants, and wishes. So in this particular case, basic living expenses, healthcare, and it's going to be a new car. Over here we got college for the kids, travel. So we kind of walk clients through a progression of these things, and then the wishes are, okay, if if it doesn't happen, the world doesn't end, but if you could just write it up the way you want, in best case scenario, what would some of these wishes be? That's where that $30,000 or $40,000 boat sometimes makes the list, the wishes. And then we just kind of give people prompters to kind of think about, well, we never really thought about getting a new home. We always thought we'd stay here in the home that we've been in all these years. Well, maybe you do want a new home. Maybe you want to downsize. Maybe you want to, get a home on the lake. Who has weddings they're going to have to pay for? They kind of try to tease.
Four
I got two that I got to pay for.
All right.
I feel for
You
them.
win.
I got two on my list. Well, we try to pull all that out because these things, weddings aren't cheap. And so we try to build these things into the plan, and they kind of help to flesh out the numbers. This is one other piece, just a piece of software. Again, I'm sorry, it's hard to read, but the reason I wanted to show this, current scenario, delay Social Security, max out your 401k. This gets into kind of some specific strategies that we model out for clients. I think a financial plan is great for getting you a baseline of where you are today, but the real value in financial planning is to be able to show different scenarios, what if scenarios, right? If I sell the company and I'm going to get $1 million, let's model that out and see what that's going to do to our financial plan. If I sell the company and I'm going to get $500,000, or I'm going to get $5 million. So once you get a base plan established, then you'll be able to show alternate scenarios based on life opportunities that may come your way or business sale opportunities. Having comfort that, okay, well, if we get this, that earlier question about how much do I need versus how much is enough, this kind of starts to help you understand what your different options may be. Okay?
And a lot of times too, as clients go through this process, they'll say, okay, I think I know what my business is worth, but until I actually sell it for that, I'm not going to, engage certain parts of my financial plan until I have certainty around that. So that, like your needs, wants and wishes. So some people might move some of their wishes into the wants category, or their wants into the needs category, depending on their financial circumstance. And certainly how that business plays a role.
Yep. Just a quick checklist of all of the different components that can become a part of the financial planning process. Income taxes, looking at your cash flow, budgeting, retirement income, investments, insurance, and estate and gift planning. Not everybody's financial plan has all of this, but every financial plan does kind of at least touch on it. There's a conversation about it to see how relevant of an issue it may be in your particular situation. But this is kind of a good basic financial plan. It should touch on these topics. Some for those who have kids in college or thinking about education funding, that might make the list. There might be other things, but these kind of cover the basics. Lastly, I'm going to close out here. Other benefits of personal financial planning for the family helps to set realistic expectations, helps to achieve an exit strategy, because if there's a different set of expectations, financial planning helps you know what your number is or what you need to have as the owner of the business, and you can kind of have these open and honest conversations with family members about this exit strategy, if it makes sense or not, and it can reduce family disharmony. If there are kids who thought they were going to get the business, but you're saying, I don't think you're ready to get the business. You know, you haven't proven yourself yet, or whatever it may be. Going through the planning process will kind of help to have good, open, honest conversations that can reduce stress and disharmony. We've seen some very ugly situations happen in families around selling the business and expectations being out of line with one another. And then for the business, certainly it can help to smooth the ownership transition. You may have a number in your mind of what your company is worth. Well, your company is only worth what somebody's willing to pay for it, right? But you also need to have in the back of your mind what you have to have. No matter what the offers are being made, you want to have in your back pocket, but what's my number that I need? So this can help allow you to go into conversations already knowing what your requirements are. And they can just help define goals with a clear vision. Okay? So the goal isn't to make more money, the goal is to live life on your own terms. That's the goal of financial planning. So with that, I'm going to turn it to Jeff now to kind of go deeper into some exit planning strategies. Any questions about any of that? We can certainly come back at the end. Okay.
Good. Well, so Alan talked about, you know, financial planning and intersected how the business can play a role into that financial planning piece. I'm going to now flip it on the other side and talk a little bit more about different exit planning strategies, and certainly how that ties back to financial, but just how these intersect. I'll just touch on a little bit, what is exit planning, right? We all have our own definitions based on our own experiences, whether you started a business, whether you bought a business from someone else, maybe you were the exit plan for maybe a previous owner. Maybe you have a family-owned business that you're maybe second or third generation, maybe you're first generation owner. Let me ask this, how many second generation business owners do we have in here today? One couple? Okay, good. So we'll touch on it just briefly. What do I need to know, right? Just some basic takeaways. We had more time, we could do a whole day session on this, so I'm not trying to make you experts. I'm trying to hopefully at least give you a few ideas to think about that you take away and go, gosh, that was interesting to know. So if I can at least give you one thing to think about, then I succeeded. If I give you two things to think about, then I did really good. And then what action should I take? So I always like these photos. There's, you know, this is first generation passing off to second generation in this case, and maybe I should have planned better. How often do we think about that? Well, we run across business owners where their exit plan is family. You know, a lot of times that's a pretty realistic, maybe not visual, but it kind of paints a picture of how well am I preparing the next generation, and maybe in some cases, maybe the next generation is more ready than you think. So that picture could actually be turned around to some degree. Just some stats. So I mentioned earlier, I'm a CPA, so there's only one slide other than these stats that has actual numbers on it, so I'll try and be light on that. But I always like starting with some stats. So Alan had some good stats. Here, if you look, 80% of businesses put on the market do not sell. Now, these are companies less than $50 million. And these are people that are looking at selling their business that maybe not have, either didn't have a strong plan, or they posted it with a broker, or they have to sell their business for a reason that was unforeseen, right? And you know, we talked about the 5 Ds. These are the surprise business transitions: death, disability, disagreement, disaster, divorce. Those are reasons people transition businesses, obviously when outside of their normal plan, right? Disaster could be anywhere from financial disaster in the business, bankruptcies, things of that nature. 30%, it's hard enough to start a business and run it. It's even harder to transfer to the second generation. 30% of those family-owned businesses that want to transfer to the next generation have a 30% chance of success. The odds are stacked against you. So you need to do everything you can. If family transition is your goal, you need to do everything you can to put the odds in your favor, right? So planning ahead, making sure that next generation is ready. The third one, which is quite striking, and I was surprised that these are based on the Exit Planning Institute. I don't know if you've heard of the Exit Planning Institute. They have a certified exit planning certification. I've been through They've done surveys of privately owned businesses, and 75% of owners regretted selling their business 1 year later. And you think about that and you go, that should be one of the most exciting times in your life of realizing your dreams and the value that you created, that you worked so hard for. How could it possibly be that 75% of business owners, even if this is wrong, it's directionally correct, I think. And we'll talk a little bit about why that might be. And I think once you hear the main reasons why, I think it'll be important for you to think about how do you make sure you don't put yourself in that situation. It's manageable. It's so as you look at that, there's just ways people can plan ahead to make sure that they don't fall into that category. So this is hard to read, but this was an analysis of private companies. There's a book called The $10 Trillion Opportunity that was written a few years ago. They did some statistics. There's 6 million small businesses, I forget the revenue cutoff, that were under 25 or 50 million in revenue. And over the next 10 years, 4.5 million of those businesses will transition that have an estimated value of $10 trillion, right? You hear people constantly talking about the wealth transfer that's going to go on in the U.S., partly because of the baby boomer situation that Al talked about. We have all these small businesses, family-owned businesses, closely owned businesses, that are going to go through some transition, whether it's planned or unplanned. So what do you do to make sure that wealth, whether it's 10 trillion plus or minus, your share of that, let's make sure that you're doing what you can to protect that and maximize it for your family and others that are part of your plan. The other thing that we're seeing too is the trend of, how many here have heard private equity, right? Private equity companies and firms buying companies. And what we're seeing is another trend is not just the baby boomers transitioning their businesses, but we're also seeing the capital market shift a little bit too. And so we're seeing much more common these large private equity capital groups buying small businesses. And they might buy a company, portfolio company, and they might do acquisitions and strategic growth. Growth is hard to come by these days, as you all know, I'm sure, in your business. And for these companies, the easiest way to grow is to acquire another business in the same industry. So to grow through acquisition. And so a lot of our clients, small businesses, less than 5 million in revenue, all the way up to large companies, they're getting calls constantly from people wanting to inquire about whether or not you're interested in selling your business. And so we get calls from time to time. People say, hey, I must have an attractive business because everyone seems to want to buy it. Well, you're getting calls. They're not actually making offers. And so the point is, and this is where we're talking about exit planning, is being intentional about that and really, here's an example. Been working with a company for 15 years. The owner said, hey, I don't need to do exit planning. I plan on transitioning the business to my kids in 10 years. I'm going to be around for a while. A couple months later, I get a phone call from a private equity group. He calls me up and he says, I'm actually now interested in selling. Well, what changed? A couple of phone calls. Got the wheels turning in his head, and now he's not quite prepared yet for that transition. But it did start the conversation to get him thinking about putting a plan together, so he's not reactive every time the phone rings, or every time he hears another idea from someone else that he knows. So, mind, hey, we're looking at transitioning to the family, or I've got a management team that wants to buy my business, or you know what, with the capital markets, I'm sure someone will want to buy it from me at some point in time. I can just wait, right? I know what I'm going to do. Well, I tell you, that's the end. The options and the end decision, that's far down the process. What I tell people is you got to really start at the beginning and to control the process a little bit more. Be more intentional about it. So there's this concept of, think of this as the three-legged stool at the beginning of your exit planning process. you first need to make sure your business is ready, right? And understand what's involved in that. Well, what's involved in business readiness? Well, what does your leadership team look like? You know, do you have a functioning leadership team? Do you have all the right people in the right place? Are they trained? Are they doing the job that you need them to do? Can they operate fairly independently? What about customers? Do you have a large customer concentration that someone else looking in would say that's a risk to the business? Another business readiness or attractiveness element is what about customer contracts? You know, a lot of small businesses do business kind of handshake deals, but if someone's going to come in and buy your business from you, they don't like handshake deals. They like inked paper. They like transactions that are documented. So think about your supplier agreements. Think about your customer contracts. All of the things that when you take you out of the equation, what would cause a concern for someone stepping into your shoes, right? So,
Jeff, one thing we see a lot around this business readiness also is how are your financials of your business, all right? So if you've been able to operate with QuickBooks or a software system that has been able to track your business finances over the years, that's fantastic. But when you're thinking about selling, you do want to take a look at those, your financials and ask yourself, if I'm a potential buyer coming in to look at my company, how would my financials present? Do they present well, or are there some things I need to get cleaned up on? And then you can either focus on those things internally or bring in your accountants or your tax folks to help make sure that your financials are consistent with what you would expect or what a potential business purchaser would expect to see on the financial statements of a company of your size.
I'm sure you all work far too hard to leave this to chance, right? And when you think about it, you know, selling a business is not like selling your home. And again, when I say selling, that could be family as well. And you don't just put it on the market one day and say, okay, I slapped some new paint on the wall and put some new carpet on the floor, and we're ready to go. In business, some of those changes can take time. They're not just cosmetic. You think about the leadership team, and if you have either someone that you know is not performing, or you have an open position that you really need someone in that role that you either couldn't find the right person or you haven't hired. Those are all the things that are going to help get your business ready and more attractive. So when we talk about business readiness and business attractiveness, there's so many different elements beyond. You know, financial is a great point that Alan brings up that you should be thinking about. So all those things that maybe it doesn't keep you up at night, but think about if someone else was stepping into your shoes, what would concern them about that? Well, if it doesn't give you a high mark, you're probably not quite as ready as you think in those areas. Alan talked about financial planning. We're not going to get into that, but understanding what the impact of transitioning or selling your business does to your financial plan, absolutely critical. I would do that before I would even get to what are my options. The personal readiness goes back to that 75% statistic. People that regret selling their business after 1 year. Why? What am I going to do? I'm bored, right? How many times, Alan, have you probably talked to a business owner that said, I'm just going to golf more? I tell you what, I don't know if any of you golf. The more I golf, the more I dislike it. Anyone else feel that?
Yeah. I've got a client who, that was exactly what he did. He was on the amateur golf tour in the state of Indiana, big time golfer. 6 months into retirement, he hurt his thumb. So all of a sudden, this idea of no longer liking it, golf became very painful for him now. So now he had nothing but time on his hands. And he was just burning through money. He said, man, I got to go back to work. I'm going to run out of money. Right. I mean, my passion, I can't do, and it's painful for me, and I'm just spending money out.
Right. So what are you going to do? What hobbies do you have? What interests do you have? You got to keep your mind active, and I'm sure you all do in different ways, but being very intentional about what am I going to do when I don't show up at the company anymore. And that might be years away, but start to think about that, because you know, I have a business owner client, he's 82 years old. And we've been talking to him about exit planning for years, and he goes, what am I going to do? Because I hate golf. You know, I bought my wife a house down in Arizona so she can go to once in a while, but I can't stop. Well, working isn't a bad thing. I'm not, you know, that's his life, and there's different ways you can do it, but his employees, his 500 employees are saying, I wonder what's gonna happen when he dies, you know? And so he's actually creating more concern in the business by not having a plan to all the people that he really cares about, his customers, his employees, his community. All those things are at risk because he's unwilling to put a plan together. And because he doesn't have it. And that's all because he doesn't know what he's gonna do when he leaves. Right? I wanna talk a little bit about this concept of value versus income, and really just have a little bit of a discussion around how to think about your business in terms of what it's worth, right? All of you operate in an industry, your respective industries, and you all have your own idea of what you think your business is worth based on your beliefs and understanding of that business. Whether that's true or not is based on how transferable is that value to someone else. So when you think of exit planning and the value of your business, you have to equate to, well, that might be what it's worth to you, with you running it, but what's it worth to someone else without you? And if that's an owner-dependent business, it's worth less to someone else than it is to you. And far too often we see business owners disappointed, frustrated, and even mad when they're going through the process of selling their business, and the offers they're getting for their business are not what they think their business is worth in their mind. And so we got to bridge that reality and perception, and also even help the owners change the mindset of how do you build value, right? And so a lot of people talk about, a business might be worth a multiple of earnings, right? People use the term EBITDA. That's an accounting term around earnings, and some of you may have heard that, but just think of what's my true profit of my business. And every company trades within a range of multiples, right? One industry might have this range of multiples, another industry might have this range of multiples, and I would say, just as simply say, are you in the middle? Are you on the low end? Or are you on the high end? And think about that in the concept of, well, what have I done to create transferable value, right? What have I done to get my business ready? What have I done to make my business attractive and sustainable, right? All those questions will tell you where in that range of value do you fit. If multiples in your industry are 4 to 7, 4 times earnings or 7 times earnings, then, and you think you're in the middle and you're a 5.5, well, what do I need to do to make that a 6 or a 7, right? Thinking about it in terms of value and sustainable. I'll talk a little bit about, and I think this is another concept that most privately owned business owners don't necessarily always think of is, and even in the previous session, we talked a little bit about taxes and income management. And that's certainly important in your privately owned business. But think of what's your reported earnings, maybe what you show on your tax return, or your internal financial statements, or even if you have an audited financial statement, under accounting standards, that's not necessarily the true profitability of your business. Well, why is that? Well, business owners make decisions to manage income for tax purposes appropriately, but that may not always reflect what the true earning potential of the business is, right? So if you think of your business just on what shows up on your tax return, well, that might be managed based on tax law to intentionally be depressed down to the lowest appropriate number, but your company might be generating true value up here. So kind of get your mindset in what's the true value of my business? What's reported earnings versus real earnings? And a lot of small businesses report their financial statements internally on a tax basis. Well, tax basis is usually lower than the real tax. So this is the only number slide I have. Here's just a simple example to kind of frame up in your mind. If a company has $1 million of reported or tax income, well, what are things that actually get you to the real number? Well, maybe the owner said, you know what, I own the business, I'm going to take another bonus this year. Well, if a buyer came in and owned your business, they may not, they might normalize that compensation of the owner. And so we could maybe have an add back to to our income because we're intentionally depressing the earnings of the business through a bonus that we wouldn't do if we hired someone to manage the business that wasn't an owner. Maybe we have some discretionary shareholder expenses going through the business that you know, again, a buyer wouldn't take those on, right? A buyer's gonna say, well, that's not a recurring expense. That's just an expense that the shareholder's making on a discretionary basis. What if we had a one-time bad event last year? We had a customer bankruptcy, right? I just use that as an example. A lot of other things that could come into play. Well, obviously, this is a one-time negative event, but the true profitability of the business without that would have been closer to, in my example, 1.2 million. So get your mindset thinking about what's real value being created versus reported value or income. Now you think about it, just simple concept of multiples, right? Again, this is the math exercise of this discussion here today, but if you just took your reported earnings of $1 million times a multiple of 4, right? I like simple math and I like round numbers. And that would tell you that your business might be worth, in your mind, $4 million. If you took that same $1 million, the reported number, and said, gee, if I could go from a low to middle range of value to maybe a best in class or middle of the road, by doing the things to make your business more attractive and transferable and ready, you know, just by changing the multiple, you've increased the value of the business in this example $1.5 million, so 38%, right? Well, what if we took the real number times that? Now that's a different value in your mindset to be thinking about. So think about what you can do. Again, think big picture. You don't have to know what your business is worth down to the dollar, but you need to be thinking about decisions you're making in the business to intentionally impact what range of multiple you're gonna trade at if you're gonna sell your business. Even if it's an internal transition or a sale to your management team, you still should be thinking about what's it worth.
Can I ask a question?
You sure can.
If you have family working for your business, like my son and my daughter,
yep,
and they get paid wages, do we put that into the, added into the profit up here? Our vehicles that we use that are company, or all the assets that we take from the company to use as personal, can we add it to the top?
If they're outside of what a buyer would do, if they're if someone else owned the business and they would make those same decisions, meaning we need the same vehicles, and if it wasn't your kids working in the business, we'd have to hire someone else to replace them. Okay. If your kids are getting paid, and we see this from time to time, and maybe, and I'm not suggesting you're doing this, but we've seen from time to time family members are on the payroll, and they're working, but maybe if they weren't family, maybe they wouldn't be working at the business. That would be an add back, right? That would be an expense that a buyer wouldn't have because they probably wouldn't employ those individuals, or they might employ them in a different way. But if these are people, family members working in the business that are working hard, productive, they're getting paid what they're worth, then they would not be an add back on here. This would only be things outside of the ordinary that you're making discretionary owner decisions about.
So the second part of your question about the personal expenses, those would be?
They would
go
up in there.
The personal,
okay.
Yep. So just remember, big picture. Think about what is my business really earning outside of the masking of taxes and other things, and where might I fall in the range of multiples?
Another question.
Yeah, go ahead.
What if somebody approaches you and just wants to buy your business for whatever your assets are,
Yep.
and versus this?
So a lot of industries actually that's a great question. Every industry trades at a different kind of model, right? Software companies trade at multiples of revenue. Traditional manufacturing and distributions trade at, multiple of earnings. Some construction companies are usually the market value of the equipment plus some number. So every industry is a little bit different, but if someone comes in and says, your equipment, I would also say, don't go based on what's on your books. I would go based on what it's worth. Because you might have depreciated the value of that equipment down to almost zero on your balance sheet, but it still has value in the marketplace, right? So that's the difference between reported versus real as well. So if someone came in, I think you also have to ask yourself, what's my business worth in terms of the intangible value, right? Maybe you have some key customers that someone wants. Well, that's worth more than the equipment on your balance sheet. But if you have a labor force that's very desirable, that's worth a lot. And that should be worth a lot more than just the value of your equipment.
So would we go back to the other way?
It's one way to think about it, right? It's I wouldn't say that this is certainly not a one-size-fits-all, but it's a way to get your mind starting to think about value in the context of what can I do to increase what it's worth. And to your point, it probably is some hybrid method of this. If you have a heavy capital equipment business, though, certainly the market value of the equipment, what else could it be used for, certainly comes into play. Right, but a business, if a financial buyer comes in, they're going to be looking at, what do I have to pay you for your business, and what am I going to get in return? Well, what they're going to get in return is some future cash flow of the profit of the business. So it still has to work. The number still has to work, and then they place a risk factor on that.
Does this percentage, does that go by like how many years it would take for that buyer to
recoup their investment?
Yeah, I wouldn't necessarily even tie it necessarily to that, but it's kind of a range of and again, in this I'm just using examples, right? Every industry is different. The range of multiples changes by the economy too, right? If we're in a recession, those multiples compress, right? If we're in a booming economy, those multiples expand. The question that you can't control the ranges, but what you can control is where on the spectrum of multiples does your business fit? Are you on the low end? Are you best in class in your industry and you're on the high end of the range? Or are you kind of middle of the road? Right? And that's how a buyer's going to be thinking about it.
And you might distinguish a stock sale from an asset sale, because there's tax implications there.
Yeah, let's touch on that just briefly. So there's two ways someone can buy your business. They can buy the assets off your balance sheet, which could even include intangible assets like your customer list, your supplier agreement, your labor force, right? Those are the assets. They can buy those, but or they can just buy the stock of your company and just take over your business. And without going into too much detail, there's certainly some tax ramifications for you as the seller, and there's certainly an opportunity for the buyer based on what you pick. So if you sell the assets on your balance sheet, there's probably a larger tax hit because you have to pick up certain depreciation, recapture, and again, I won't go into a lot of details, but more of that income gets treated as ordinary income on your tax return, versus if you sell stock, more of it's treated like a capital gain. And so if you can just kind of big picture, a lot of times, people will say, hey, I think my business is worth $10 million. Well, $10 million under what? An asset sale or a stock sale? Because a $10 million asset sale might net you less after-tax proceeds than an $11 million stock sale, right? Or vice versa. I'm sorry, I said that backwards. $11 million asset sale might net you less than a $10 million stock sale. So again, you don't have to be experts in that, but I think to just be thinking about the structure of how you sell certainly plays into that quite a bit. Was there a question on the back? Nope. Okay. So again, takeaway, just think, what's your real number? Talk a little bit about exit options. As you know, this is what, thinking about the exit options should certainly play a role in how you plan, but you shouldn't start with the end in mind, and I think I said that earlier. I've had people come to us and say, well, gee, I want to transfer this to the next generation, and we say, okay, have you mentioned that to your daughter or son? Well, no, not yet, but I think they know. Okay. Well, maybe we should have a discussion with them and see, and I've had situations where you sit down with the son or daughter and they say, I don't want to own the business. I like my role either in the company or outside the company. Maybe they're not even working for the company. They say, I don't want the risk, or I'm just not interested in it.
I don't mind the dividend payments,
Yeah,
Report on the dividend
yeah.
balance, but I don't want the.
Or just, why would I wanna work that, I see how my parents worked, or whatever, there's 100 different reasons that next generation may not be ready. Or they say, you know what, I'd be interested, but I don't feel comfortable. Okay, all right, well, if there's a long enough time horizon, maybe we can do some things to put that person in different roles in the organization, to either grow into a leadership role, or maybe they become an owner and they don't even work for the company, right? This is that disconnect that Alan talked about earlier, that ownership does not actually equal management. We have a lot of multi-generation family-owned businesses that we work with that the family doesn't even work in the business. They own it. It's an investment. They're emotionally tied to it. They love it. But they hire an outside board and a management team, and that's who runs the business on their behalf. So disconnect the two. So your exit options, internal, so we talked about management, existing owners, internal buyouts. There's pros and cons to that. Same with external. This you have a little bit more control over, right? More likely that the business is going to continue to operate similar to the way you operated it. So a lot of times, business owners don't want to talk about the external options because they get concerned about, what kind of legacy will I leave? What control do I have over the business? If a private equity group comes in and buys my business, will they take the jobs out of my community, right? And it's an important decision. And I will tell you, I'm not speaking for all of them, but most private equity groups don't want to change a whole lot of your business at the end of the day. But there are some horror stories out there that I think give them a bad name as well, which I don't think is fair across all of them either. But with an external sale, you're probably going to get the most value for your business versus an internal. You might leave some money on the table. And I will tell you, more often than not, getting the most value for the business is usually not number 1 or 2 on the list of priorities for most business owners. They will be more than happy in many cases to leave money behind for the next generation, or to make it more desirable for the management team to buy them out. I worked recently with a construction company, and the owner said, I think I can get 20-30% more money if I sell to an outside party, but I don't want to do that. I love my community, I love my employees, I love my customers, and I've made enough on the company, so I want to make sure that I'm doing what I can to leave the company in a good spot for the next generation. I think that's where a lot of planners, exit planners, kind of get crossways with a lot of maximizing the dollars. It's usually not the case. It's important, but it's not at the risk of compromising other goals. Talked about family recount. That would be, maybe the reason some people want to sell their business is because they need some liquidity for whether it's retirement or other things. Well, you can recapitalize the business. Maybe you sell part of the ownership. Maybe you leverage the balance sheet a little bit. Maybe you've got a lot of real estate in the company and you have no debt on it. Maybe you take out a mortgage and then bring that money back to the owner. So the owner still owns the business, but they were able to pull some liquidity out without selling the company. And then ESOP. I don't know if everyone's familiar with employee stock ownership plan, ESOP. Basically selling it to your employees through a qualified plan. It's a little more complicated, but it is an option. So let's get to what can you do. I think the big takeaway here is start a conversation. Think about who are your advisors inside the company, your leadership team. Maybe it's outside the company, maybe it's your legal advisor, maybe it's your CPA, maybe it's your financial advisor. Start a conversation, and usually it takes multiple disciplines to put together a comprehensive plan to think about your exit strategy. So start that conversation, and don't get caught up in, well, what if my employees find out I'm thinking of selling the business? I go back to my 82-year-old business owner client and say, his name's Dick, and I say, Dick, you're the only one not talking about your exit plan, because everyone else is. And whether they're telling it to you to your face, they're talking about it behind the scenes. And so why don't you just be real about it? Doesn't mean you have to sell the business tomorrow, but at least tell people what your plan is. If you die, what's going to happen to the business? Because people are leaving, leadership team members are leaving the company because they don't know what his plan is. And that's unfortunate. And so that could Not talking about it can hurt more than talking about it. Think about, we talked about business readiness and business attractiveness, so think about what steps can you take to make the value of your business transferable to another owner. Inside, outside owners, doesn't matter, son or daughter. If you're transferring it interfamily, you want that business to be worth as much as you can, because you're not only building it for you, you're building it for the legacy of your family. Financial plan, find your wealth gap, understand how that's all going to play into it, which includes estate planning, financial planning, tax planning, and then consider your options. There's another statistic on how many business owners don't know what their options are. Most think they only have two options: sell to a competitor or transition to family. Well, there's more options than that. You know, thinking of ESOPs and thinking about recapitalization or other ways to accomplish your goal. There's more than just one or two. And that's all I have. So, what questions do you have? Did this spur any thoughts that you can take back with you and say, okay, I have one or two things I can do in my business? I mean, what questions do you have? Alan's here as well. Everyone going to start a plan?
Either we covered the material very well, or we put everybody to sleep.
Yeah.
Well, we didn't put you to sleep.
No.
That's some good questions.
No, for me, it's I guess, again, it's when do you got to put that date on when are you going to keep working? Do you have a date or a time you think you're going to exit the business yourself? For myself, I started the business, my wife and I, Barbara, and we're tied to it, financially, emotionally. Our family's tied to it. So it's, I think for a lot of business owners to sell to someone else out of the family, it would have to, we would want to keep, what we've built and our employees and our customers. We don't want someone to come in there to destroy that because they haven't built it up like we have.
Right.
That's a concern for me, myself. Of course, if someone comes in and says, we're going to just give you this much money, and it's real attractive, yeah. I mean, that kind of makes that pill easier to swallow.
Yeah.
And also, if we transition to family members, how do they don't have the pockets to purchase, what
Right.
we would sell for.
Right.
So I guess it would be a financial, we would do it over time, I would imagine.
But he also, a concern was ours, he's like a personal guarantee on, stuff that
Our
we have
vendors
to,
and suppliers.
Sure.
Suppliers, and how do you pass that on to your children? Do they have to sign? Do they have to, you have to qualify for that?
Depends on ownership percentage, right? So certain banks, and in the construction industry, if you're a construction contractor and you have bonding, and you're personally guaranteeing, the surety and different components there. So a big part of it is educating the next generation, whether it's this one construction contractor that I'm working with, that we're selling his business to his 4 key management team members, and we sat down, brought in the insurance company that does their bonding, and educated them on what risks they would be taking. They're all excited about ownership, right?
Right.
We put the models together, and we're going to have them write a check up front for some skin in the game, but most of it will come over time based on the profitability of the business. Most of the profits will be used to pay the owner, the original owner. But the discussion changed a little bit with a couple of them when they found out what kind of risk they're taking on when they're signing those personal guarantees, and their whole mindset shift. A couple of them go, ooh, I'm not sure I want to sign up for that.
Yeah,
and so you got to educate them on what that means.
And I think that's what a lot of, whether they be in your management team or children, that work for the business, the risk involved.
Mhm.
That they haven't felt the risk. They haven't signed a piece of paper saying that if you default on this, we could take your house.
Right.
Or your property.
Right, and you sign it every day.
Yeah,
you know,
I mean,
you bear that.
for years, we've been signing those things, and we understand the risk, they don't.
Yeah.
Someone told me that, and on a lot of those, there's two places you can sign, to start, if you wanna transition to a family member, start getting them to sign that now. And as you wanna step away, you take your signature off, theirs will still be on there.
Yeah. Well, and you
I'm
gotta
not
get the
sure
bank,
how-
you gotta get the bank comfortable with
That's
it
what's
too,
gonna
right?
drive
So if the
that,
bank
yeah.
goes, I know you, the two of you, but I
Right.
don't know your son or daughter, then they're gonna go, well, that signature doesn't mean anything to them until they get to know their capabilities and their ability to run the business the way that you two are running the business, and others that are helping you. But I think that an educational process, whether it's the two of you or starting that conversation, maybe bring in your trusted advisor who can help educate them, and you know, you just gotta get the wheels in motion, and the longer you delay it, the harder it is for them to understand what it's gonna take. The sooner you might find out they have no interest at all, right? And I'm not suggesting that, but that could be one of the possible outcomes.
Well, that happened recently to one of our vendors that had a family business, had been in the family for 125 years.
Yep.
And he was the last family member
Mm.
that ran the company, and he had children, but none of them were interested in taking over the business.
Right.
They had built other businesses, they worked for other people, they weren't interested, and he had a stroke at a fairly young age, and he said, I don't have anyone that's gonna take this over. There's no one interested. So he sold the business, he got a good deal for it, but
He didn't have many options.
yeah, and I think he was reluctant probably because the business had been in his family so long.
One of the, you know, when you said that all the kids are working in the business, that's a great point, because one of the considerations is, if, depending on what each child is doing in the business, if you were to sell, would they stay behind in that business? Because on one hand, you're potentially gonna be disrupting 3 or 4 families, not just your family, but their
Right.
families as well, right? So having a kind of an honest conversation with yourselves and your children about, okay, if we were to sell, would you still be in this business? Like Jeff mentioned earlier, you know, you're making a fair wage, you wouldn't necessarily get kicked out the door as soon as we left, if a new buyer came in, because, you know, we've assessed that you're doing a good job, or not. So having that kind of tough conversation about where the kids are positioned in the company will kind of maybe help to fuel that, because that is a tough one, because from a buyer standpoint, if a buyer comes in and says, man, there's all these family members in the company, not just you two, but now we have these other family members, what kind of pressure is that buyer now gonna feel to keep them on, or
Right.
get rid of them? What does that do to their perception of the value of the business? So it can be very, very tricky, but it starts with good open dialogue with your kids, and then if you do have, do a valuation of the company, you know, you have someone come in and help do a valuation, what is this business worth? They're gonna talk about that dynamic and what that might look like.
And that's something that CLA can help us with.
Yeah, we do valuation work all the time.
Yeah, and I think the other thing too, you know, the most sensitive transitions is the family,
Yeah.
right? Because you're going now multi-generations, and you know, we see sometimes where the first generation doesn't step away the way they promised, and sometimes they're overly involved. So that'd be the other conversation that the two of you should talk about with your kids, is what is your involvement and transition of your roles over time? Because if you're putting them in ownership roles and leadership roles, obviously you don't want to undermine their authority and their ability to operate the business, because at some point you won't be showing up anymore. Yeah. And then the risk piece is certainly I think an element of this that most people don't think about all the time. I had one business owner put this probably the most clear to me. He said, Jeff, I don't go to casinos, but he said, I gamble every day. Right? And that's what you're all doing at running your business, with the bank, with your customers, you're putting everything on the line every day.
And the last piece about buying over time, if you said they don't have the finances to take over, there's 2 schools of thought on that. So if I'm advising you as your advisor, your trusted advisor, I'm gonna tell you, get all of your money as quickly as you can. Because as much as you may love your children and the management team, if you accept a payout, the longer you accept that payout over time, you're kind of putting that, let's say they get in and screw it up.
Yeah.
Right, and the company doesn't, so now.
Or the market
Or the
changes
market
too.
changes, or whatever it may be.
Maybe outside their control.
Now, your financial plan has been impacted because you've accepted over time. So one school of thought is get as much as you can and say, look, when we cut, we're gonna make a clean break. We don't wanna be continue to have to be guarantees for the bank, and anything that you can to make yourself extricate your personal financial picture from that company. The other school of thought is, if there's a legacy and you want to make sure the kids are interested in continuing on that business, and if you've got the wherewithal to allow them to buy it over time and you're comfortable with that risk, then absolutely, that can be a great way to do it. So there's two different ends of the spectrum on that as far as what it means for you and what it means for the continuation of the business.
I've heard of some companies when they sell in that situation that they allow the buyers to get a salary, and whatever else benefits they have, but any profit would go to the seller, or a percentage of the profit.
And there's
Like
things
an
called,
earn-out or
yeah,
something.
there's
Yes.
things called earn-outs.
If they're not gonna profit, as long as they owe the seller money,
Yeah.
they're not gonna keep the profit, they're gonna.
Depends on who that buyer is. Most of them won't be that patient or take
Yeah.
that level of risk.
Yeah.
And, you know, the other thing I'd even say to the family transitions, again, this is just my opinion, there's a lot of other good opinions about this, but, I think once in a while I hear family-owned business owners say, I'm not gonna worry about the plan because I'm just gonna gift the business to my kids when I die. So, you know, that's a method, but I will tell you, my opinion is make them pay for it. And the reason is, if you pay for something, even if you forgive the debt upon your death, it has more value to them than if they were gifted it.
Yes, I agree.
Some people may disagree with that, that's my opinion, but make people put skin in the game. And you can, again, that just means it's going into your pocket, and when you die, it just goes back to them in the form of another component of wealth, but just, there's a lot of different ways, and it's not a one-size-fits-all, but it's,
right.
you know.
Well, I think what that does, it kind of helps equal out the sweat equity that the first generation.
Yeah.
Absolutely.
Yeah. Gives them puts more pressure on them to perform. And pressure is not a bad thing in the right context.
No, you're correct, yes.
So is this helpful?
Yes.
Yeah.
Good?
Good.
Any other questions?
I had a question.
Go ahead.
I'm just in the roll forming business for just started actually 3 years, and as a builder, I'm also a builder, have been, and I just, because of that, I had to get rid of some of my building. One of the guys I've been working with for years is taking over the homes, the new home part, and so I guess and I realized when I did that knowing what it's worth is pretty difficult, especially as a contractor. And so as I structure the new business, I was curious if you have any, is there a couple things to think about that's really important in structuring it correctly so that you actually have a value when you go to
In terms of how you set it up at the outset to make sure?
That's right.
The first thing I would focus on is just maybe more formality, right? Contracts, written agreements, if you have key personnel, have non-solicitation agreements, right? So it's not so much the entity structure. I mean, there's certainly different Escort, C-Corps, partnerships and things, the legal side of it, but I would say the best thing you can do is build best practices from the start. And I go back to what are the things that you can do to make the most transferable business to someone else. And someone else could mean, someone you know and someone you don't know. And if someone else, look at it as if something happens to you and you don't show up anymore, is all the value in you? Or is the value going to be left in the business? And I've seen some business owners say, well, gee, you know, the buyer can't live without me, and I say, well, that's a problem. Because if the buyer can't live without you to run the business, then if something happens to you, then everything's gone. So you gotta make yourself, you know, disposable to some degree over time, and make sure others are filling those shoes.
And I would just add, back to the financial, how you prepare your financials and how you track the performance, the activity of the business. Err on the side of doing more than less. What I mean by that is, many times when, you know, a business is in startup mode, the way the financials are tracked and put together is kind of, hey, let's just kind of do this the easiest way we can. You know, we don't have a lot going on, so we can kind of do this in a more simplistic fashion. And then one day you get to a point like, oh man, we're doing a lot of sales. We now have to transition to a more, you know, we've outgrown this financial reporting system, so now we need a different level of reporting system. We spend a lot of time with businesses that come in looking to sell. We spend a lot of time cleaning up the financial statements before we can get anything done for them. So we'll do the valuation, help them get an idea of what the company's worth. Then we got to go through and redo those financial statements. We see it a lot. So I would say, don't necessarily get into overkill. I mean, don't exceed what your capacity is. But if you got a choice between A or an A++ type of an approach as far as tracking your financial statements, go ahead and err on the side of doing a little more. You'll save yourself headaches down the road. You know, don't overspend for software or whatever, but do as much, err on the side of doing more rather than less, I guess.
And we could go into whole other areas too that we won't touch on here to the end of our time, but all the way down to how efficient is the working capital in your business, right? Are you buying too much inventory? Do you not have good best practices on collection of your receivables? Are you paying your bills too quickly, right? Meaning if your vendor's gonna give you 30-day terms and you're paying them in 15 days, well, why don't you, let's pay them on time, but let's stretch them to your terms, because then you use that cash flow more efficiently for other parts of your business. And you know, all the way down to, you know, just thinking about what are the value drivers of your business. So again, financials report profit, but what kind of sales are the most profitable sales to you, right? Have you done a customer analysis, right? Customer A might be a big customer, but they're a pain in the you-know-what, and maybe at the end of the day, they're really not that profitable, but in your mind, you're going, they're generating a large amount of sales. So really trying to get back to what's driving the business and focus on that. So, good.
Thank you.
Well, thanks everybody.
Thanks a lot.
Thank you.
Good stuff.
All right, thank you very much.